What if the financial system you trust to hold your wealth is designed to function only as long as nobody asks for their property back? That question now sits at the center of the most significant development in precious metals markets in half a century. On January 9, 2026, the Federal Reserve activated a $25 billion emergency lending facility for silver, a program that remains almost entirely unknown to the public and even to most professional investors. This is not a routine liquidity operation. It is the first time in American history that the central bank has opened an emergency window specifically for a physical commodity. The facility allows authorized dealers to borrow physical silver from the Federal Reserve for up to 90 days at favorable rates. The window closes on January 31st, leaving a 26-day period during which the Fed is attempting to manage a problem it cannot solve. The immediate trigger is a structural collapse in the available supply of deliverable silver. The Comex, the primary futures exchange for metals in the United States, began January 2026 with 58 million ounces of registered inventory, representing the only metal immediately available for delivery against futures contracts. Between January 7th and January 14th, investors withdrew 33.45 million ounces for physical delivery. That single week removed 57% of all available inventory. The registered stockpile now stands at approximately 24 million ounces, yet open interest for March 2026 delivery totals 390 million ounces. The math is stark. Obligations exceed deliverable metal by a ratio of 16 to 1. This is not a temporary mismatch. It is the terminal phase of a market structure that has been building for decades. Behind this numbers lies a deeper reality. The United States does not own a strategic silver stockpile. The last government holdings were liquidated in 2002. When the Federal Reserve promises to lend $25 billion worth of silver, it is committing to deliver approximately 278 million ounces of metal it does not possess. To fulfill this commitment, the Fed has been approaching foreign central banks that maintain silver reserves, offering to lease their metal for 12-month periods at rates that have reached 8% in private markets. The transaction transforms a physical shortage into a geopolitical dependency. American monetary stability now depends on the willingness of other nations to lend their strategic assets to a system that has demonstrated it cannot manage its own. The physical shortage itself results from two converging forces. For 5 consecutive years, the world has consumed more silver than mines and recycling can produce. The cumulative deficit over that period totals approximately 820 million ounces. Industrial demand, driven by solar panel production, electronics, and the expanding nuclear power sector, consumes roughly 60% of annual supply. Investment demand absorbs most of the remainder. The balance was already precarious. Then, on January 1st, 2026, China implemented a new export licensing system for refined silver. China controls 60 to 70% of global silver refining capacity. The licensing system effectively removed 121 million ounces annually from the open market. Chinese manufacturers now receive priority access at controlled prices. Foreign buyers must negotiate through 44 state-approved companies whose shipments are subject to discretionary approval. The policy reclassifies silver from a commodity to a strategic resource, placing its control firmly in Beijing's hands. This event did not emerge from speculation alone. It is the latest iteration of a pattern that has repeated throughout modern financial history. In 1968, the London gold pool collapsed when 8 central banks, led by the United States and the United Kingdom, attempted to defend the $35 per ounce gold price mandated by the Bretton Woods system. For 7 years, the pool sold gold into private markets whenever prices threatened to rise above the official parity. By March 1968, speculative demand had become overwhelming. In a single week, the pool sold nearly 1,000 metric tons of gold, exhausting the combined reserves of the world's wealthiest nations. On March 15, 1968, the London gold market closed for 2 weeks. When it reopened, the official $35 price existed only for transactions between central banks. The private market price immediately rose above $40 and never looked back. The pool OOS members had transferred billions of dollars worth of gold to private buyers at the statutory price, then watched those buyers capture the full upside when the market repriced. The mechanism in 1931 was different, but the wealth transfer was identical. In September 1931, the United Kingdom suspended the gold standard after foreign investors withdrew more than £200 million from London in 3 months. The Bank of England's gold reserves had fallen to £130 million, and authorities determined that further sales to defend the fixed exchange rate would deplete the nation's monetary base. When the announcement came, sterling immediately depreciated 25 to 30% against the dollar. British citizens and foreign holders of sterling-denominated assets saw the purchasing power of their wealth evaporate overnight. British exporters, whose costs were now denominated in a cheaper currency, gained a competitive advantage. The real value of sterling debts contracted, Wealth moved from creditors to debtors, from external holders to domestic producers. In 1933, the United States government executed the most direct wealth transfer in modern financial history. Executive Order 6102, signed on April 5, 1933, required American citizens to surrender their gold coins, bullion, and gold certificates to the Federal Reserve by May 1, 1933. The government paid $20.67 per ounce, the statutory price. In 1934, the Gold Reserve Act raised the official price to $35 per ounce, devaluing the dollar by 41%. Americans who had complied with the law lost the entire 41% gain that accrued to the government O.S. gold holdings. The Treasury's balance sheet expanded by billions of dollars. The real burden of fixed dollar debts contracted. The confiscation transferred wealth from law-abiding citizens to the state, from creditors to debtors, and established the precedent that monetary authorities could alter the terms of property ownership during crises. The pattern repeated in 1971, when President Nixon closed the gold window, ending the Bretton Woods system. Foreign central banks held hundreds of billions of dollars in reserves that were contractually convertible into gold at $35 per ounce. The suspension meant those claims could no longer be exercised. The dollar's value in gold terms fell immediately. Foreign governments lost the contractual right to convert their reserves into tangible assets. The United States preserved its remaining gold stock and gained the flexibility to pursue monetary policy unconstrained by fixed exchange rates. The wealth transfer was clear, from dollar reserve holders to the issuing government. Each of these events shares a common architecture. They occur when the financial system's promises exceed its physical capacity to deliver. They unfold in stages. First, a gradual erosion of underlying assets. Second, a period of official denial. Third, emergency measures that delay but do not resolve the imbalance. Fourth, a breaking point where the gap between claims and reality becomes visible. And finally, a wealth transfer that favors those who position themselves correctly and penalizes those who trust the system's assurances. The current silver crisis is following this exact sequence. The erosion phase lasted 5 years, as supply deficits accumulated and Comex inventories declined from 200 million ounces to 24 million. The denial phase is visible in the language used by market participants. Bullion banks continue to sell silver derivatives at ratios of 12 to 1, 50 to 1, 240 to 1, confident that emergency liquidity will prevent a delivery failure. Industrial consumers operate on 30-day inventory cycles, assuming they will always be able to source metal at prevailing prices. Investors allocate to silver ETFs, believing the shares represent ownership of physical metal, when in fact, most ETFs hold unallocated accounts whose metal may be encumbered by multiple claims. The emergency measures are now active. The Federal Reserve's $25 billion lending facility is the functional equivalent of the London Gold Pool (RS) intervention sales. It provides temporary liquidity but does not create new metal. It allows the system to continue operating for 26 more days, but only by transforming a physical shortage into a geopolitical dependency. The Fed must persuade foreign central banks to lease their silver reserves to a system that has demonstrated its inability to manage scarcity. Those foreign banks will earn 8% lease rates, but they will also gain strategic leverage over American monetary policy. The wealth transfer is already in motion. From the United States to reserve holders, from paper claimants to physical owners, from industrial consumers without inventory to those with secured supply. The final phase, where the gap becomes visible, is approaching rapidly. The Comex registered inventory of 24 million ounces must cover 390 million ounces of March delivery obligations. If withdrawals continue at the pace of early January, the exchange will be forced to invoke force majeure clauses that convert physical delivery obligations into cash settlements. When that occurs, the price of silver in paper markets may decouple entirely from the price of physical metal. Retail buyers are already experiencing this bifurcation. Premiums on physical coins and bars have reached 30 to 50% above spot prices. Shanghai silver trades at 10% premiums over Comex. The market is pricing in delivery failure before the official announcement. The psychological mechanisms that prevent recognition of this pattern are well documented. Normalcy bias leads participants to assume the system will function as it always has, even as underlying conditions deteriorate. Authority bias causes investors to trust that central bank intervention guarantees stability, when in fact it signals systemic failure. Recency bias causes risk managers to calibrate models to the past 20 years of moderate volatility, ignoring historical precedents of market closure and confiscation. Moral hazard encourages banks to accumulate extreme leverage, confident that emergency facilities will prevent default. Information asymmetry ensures that retail investors operate with incomplete data, while institutional players know that paper claims exceed physical metal by multiples that render the system mathematically insolvent. These biases are not random errors. They are structural features of a financial system that relies on trust and confidence to function. The system works precisely because most participants do not question its mechanics. The moment a critical mass of investors demands physical delivery, the mechanics become visible and the trust evaporates. This is why the Federal Reserve did not announce the silver lending facility through a press release. Transparency would accelerate withdrawal requests. The facility operates in the shadows because sunlight would collapse the fractional reserve structure. The implications extend beyond silver. The same architecture underpins every major derivatives market. Treasury futures, gold futures, commodity indices, and currency swaps all operate on assumptions of liquidity and two-way convertibility. The collateral pools that support these markets are interconnected. A delivery failure in silver could trigger margin calls that spread to gold, platinum, and treasury futures, as banks are forced to liquidate positions to meet obligations. The repo market, where banks fund their daily operations, could seize if collateral values become uncertain. The Fed's standing repo facility, which provided a record $26 billion in emergency funding on December 31st, 2025, suggests that liquidity stress is already present. If the pattern continues, the next phase will involve policy measures that alter the rules of ownership. The historical record provides clear precedents. In 1933, the U.S. government criminalized private gold ownership. In 1971, it unilaterally abrogated international contracts. In 1968, it closed the world's largest gold market for 2 weeks. Each time, the authorities acted not to preserve the system as it existed, but to create a new system that transferred wealth from those who trusted the old rules to those who understood the new ones. The question is not whether silver will be revalued. That is already happening. Physical silver has risen from $30 to $94 per ounce in 12 months, a gain of 213%. The question is whether the revaluation will occur through orderly price discovery or through a discontinuity, where paper markets collapse and physical markets trade at premiums that reflect true scarcity. The Federal Reserve's emergency facility suggests that authorities are attempting to manage an orderly transition. The 26-day window, the quiet activation, and the foreign leasing arrangements indicate that the goal is to prevent a public panic, while buying time for banks to reduce positions. But time is not on their side. China's export licensing system gives Beijing control over the marginal supply of refined silver. The 44 approved exporters can choose when, how much, and at what price to ship metal. They can prioritize domestic users, leaving foreign buyers to compete for whatever is allowed to leave the country. This is not a market. It is a rationing system. And it places China in a position to determine which industries, which countries, and which companies will have access to a material that is essential for solar panels, electronics, and nuclear reactors. The nuclear industry is a case study in how scarcity redistributes power. Each large nuclear reactor requires 56,000 ounces of silver for control rods and electrical systems. The planned expansion of nuclear capacity to meet AI data center demand could require 85 to 90 gigawatts of new generation by 2030. That translates to nearly 5 million ounces of silver per year for reactors alone, equivalent to 20% of current industrial consumption. When supplies are constrained, governments will decide which industries receive priority. The nuclear sector, with its strategic importance for energy security and technological competition, will likely be favored. Solar manufacturers, electronics producers, and other industrial users will face higher costs, reduced output, or forced substitution with inferior materials. The wealth transfer is already in motion. Those who hold allocated, physically vaulted silver outside the banking system have seen their assets appreciate by 213% in 12 months. They face no counterparty risk. Those who hold silver ETFs, futures contracts, or unallocated accounts hold paper claims that may never be honored in physical form. When Comex invokes force majeure, those claims will be settled in cash at a price that reflects political priorities, not physical scarcity. The difference between the cash settlement price and the physical market price will be the measure of wealth transferred from paper holders to those who control the metal. This is the mechanism that repeated in 1968, 1931, 1934, and 1971. It is the mechanism that is repeating now. The only difference is the asset. Gold was the monetary metal of the 20th century. Silver is the industrial metal of the 21st. The pattern is identical. The wealth transfer is inevitable. The only uncertainty is who will position themselves correctly before the gap becomes visible to everyone. The process is unfolding in real time. The Federal Reserve's facility closes on January 31st. The March delivery contracts come due shortly after. The registered inventory continues to decline. China's export licensing system is now fully operational. The lease rate for physical silver remains at 8%, signaling that possession commands a premium that paper cannot match. These are not predictions. They are observable facts. The question is, what happens when the system that was designed to work on trust is forced to work on proof. History suggests the answer. When trust evaporates, proof becomes the only currency that matters. And those who hold the proof hold the power.